spoke about what not to do. And in what not to do, we spoke about how derivatives, namely future and options, are weapons of mass destruction and they should be avoided. And that is where the word consistently comes. Because when you're playing futures and options, there is no consistency. There may not be consistency unless you're an expert at hedging. And as a hedging instrument, they are brilliant, and which is why they are so popular. But because of the leverage that they provide, they are extremely risky and should be avoided for youngsters at all costs. So before we move to any field, we need to understand what the market dynamics are all about. In market dynamics, what all is included? Who are the players? What is their objective? What is the role of information? What are generally the sources of information? What is the importance of floating stock, volatility in the market? These are a combination of all these factors is what is going to lead you to understand market dynamics. Although the list that I have provided and what I'm talking about is not an exhaustive list, it's an indicative list. But once you get few of these points, once you get cognizant of all these points, chances are you're going to be able to discern other things. It's going to lead you to think in that direction and discern for yourself as to what could be the other market dynamics that affect all the other factors. Let us begin by market participants. As far as market participants are concerned, I'm sure all of you would have heard of the institutional investor. Now, institutional investors can be of two types. They can be either foreign or they can be local. Now, time and again, you will read in the newspapers that, FII is buying or local institution is buying, local institution like an LIC is buying. In fact, sometime later during this year, LIC is also going to come up with an IPO. And I would urge all of you to look at that IPO very carefully and also invest in that IPO. What do you need to invest in an IPO? Obviously, you need certain savings to invest in that IPO. Other than savings, you also need demat accounts. So demat accounts, you can go to your local bank or to any broker who will open any depository participant who will open a demat account for you. So coming back to market participants, so you have institutional investors who could be either foreign or who could be local. Then you have mutual funds. Mutual funds, as the name suggests, are people who collect funds from many people. From small investors, they collect the funds. All the funds are pulled together, and then an expert investment manager or expert fund manager will deploy that fund in the market, and each mutual fund has its own mandate. Some mutual funds will invest only in small cap securities. Some will invest only in large companies. Some will invest in index only, whether it is the Nifty or the Sensex. Some could be sectoral funds. Like when we say sectoral funds, it would mean it is only investing in pharma sector or software sector or your defense sector, maybe public sector undertakings. So they are thematic funds. So there is a theme that underlies them. Then there are certain funds that are a combination of debt and equity. So they are known as balanced funds because equity by their very nature are risky. Another mantra that I want to give to all of you is wherever there is a higher return, what is also unsaid but equally true is that there is a higher risk attached to it. So Higher the return, higher the risk. So many people throughout your life are not going to tell you this. They will keep pushing to you, अरे return बहुत अच्छा है, इसमें इतना high return मिलेगा. But what they are also not telling you is wherever there is a higher return that is attached, your risk profile becomes higher. So to elucidate this point or to drive home the point, आप देखो कि your risk is lowest in the bank FD, right? But what is the kind of return you're getting? You're getting 5.5%, 6% at max. So as you go up the risk ladder, you will see that the return is getting better. So vice versa is as you go up the higher return ladder, the risk also is higher. So I was talking about balanced funds. So because equity are risky propositions, because it gives a higher return, many funds created a product called the balanced fund, which is a combination of debt and equity. 50% debt, 50% equity. Now the proportion could manage from fund to fund, from fund manager to fund manager, and from mandate to mandate of the asset management company. Now, so part of that fund is always going to earn a certain amount of interest. So that is the base earning. And the spice is provided in terms of the higher rate of return that the fund manager earns through your equity investments. Then you have the favorite category of retail investors. Now, retail investors could be either high net worth, they could be family offices, they could be hedge funds, or they could be small investors like you and me. These small investors ostensibly get their savings to the market because they don't have very many avenues where they can invest their money, where they can put in their hard-earned money. So stock markets are one place where your hard-earned money can give you a much better return than any other. Then you have the traders. Traders are someone who will probably sit with multiple screens in front of them. Their only job is to do buying, selling, buying, selling, buying, selling. They don't look at too many fundamentals of the company. They keep only looking at price. For them, price is God. In Gujarati, there is a saying, Bhav Bhagwan Che. So that is what traders are all about. So they will constantly buy, sell. At the end of the day, they will keep their position zero, maybe carry some stock with them for next day, but constantly trade in the market and try to remove money from the trading terminal. Jobbers and scalpers are people who trade in extremely minute differences. Maybe the difference that they deal in is 5 paisa. So whereas a trader would look for a 5 rupee difference between their buy and sell trades, a jobber or a scalper would be happy with a 10 paisa difference. But the volume of transaction is so high in the day. In fact, now this activity is being done by computers. Earlier, this was done physically. Then it moved on to being done on trading terminals. But now there are sets of computer servers where a program is fed in, and that program, as per situation in the market, will decide whether it wants to buy or sell and take that decision. And I must tell you a fun fact over here, that trading systems have become so fast that trading can be done in microseconds. Now, microsecond sounds very fancy, but what is a microsecond? The first time I asked a technology guy, what is a microsecond? I know it is a very small unit of a second, but how small is it? So he said, Alok, if you take 1 second, you splice that 1 second into 1 million parts. That 1 millionth of a second is a microsecond. So BSE servers do trading in 6 microseconds. So you can imagine what is the speed of trading. No human mind can actually even think that fast. And it is these computers that are, turning in huge volumes of data, doing this kind of trading. Now, mind you, all these people that I have discussed, they are all on the same market. What you see buy price and what you see as a sell price on the screen is nothing but a combination of buys by these people and sells by these people. Now, each one of them is in the market for a different reason. Of course, we've left out speculators, arbitragers, and operators. They are also market participants. Speculators, by very nature of their name, are speculators. They look at the future. They not only look at the future, but they have leveraged positions. Leveraged positions means nothing but in cash market, if you have 100 rupees, you can buy stock worth only 100 rupees. But in a leveraged market or in the futures market, with the same 100 rupees that you have, you can take 10 times exposure. So with 100 rupees, you can buy stock worth 1000 rupees. So which means by putting in smaller sum of money, you are taking in a larger bet. Now that is what speculators do. They try to look into the future and see whether this stock will go up or down. And if it goes up, if they think it is going to go up, they will deploy that 100 rupees, hope that it moves higher in the future. But on the flip side, a speculator is someone who can also sell a stock. If he thinks that the stock is going to go down, he or she may not have that stock. But if they believe that the company is going to go down, they can, the market allows them something called short selling, which means you sell something that you don't have. And when the price goes down, you buy it back and you settle your position. And the difference between your sell price and your buy price is your profit. But what happens if the price goes up instead of going down, and I have sold something that I don't have, the price has gone up, I'll be forced to buy it at a higher price to settle my trade, and in that case, I will have made a loss. Arbitragers are individuals who buy in one market, sell in the other. In India, we have a situation where you have NSE and BSE. There are two markets. Let's say the stock of Reliance, it is traded on BSE also, it is traded on NSE also. So when a trader looks at both the screens, he sees prices on both. Let's say Reliance is available at BSE for 101 rupees, but you are able to sell it on NSE at 102 rupees. So what the trader will do is quickly he'll buy Reliance from BSE at 101, sell it on NSE at 102. This difference of 1 rupee that he has made is known as an arbitrage trade. So the speciality or the characteristic of an arbitrage trade is simply it has to be of the same commodity or share as in this case. It should be uniform. The quantity in terms of quantity, quality, and everything, it should be same. So a share by its very nature is the same whether it is an NSE or BSE. So if you are getting it cheaper at exchange A, you'll buy it here and you'll sell it at exchange B. Operators, I don't think are something that I would like to discuss for a classroom session. As we go higher and higher in this field, it gets more and more complicated. So operators, to explain what operators are, what they do, how they operate itself is another topic by itself. So I'm skipping operator for the time being. Now let us look at the objectives. What are the objectives of all these people? Each of these people have a different objective. Of course, we started off with our main objective, that is to make money from the markets. How? Consistently. So yes, that is the underlying theme. Everybody wants to make money, but each one, by their nature of being, is a different person. or a different entity, and their behavior is therefore different. Now, how do institutions behave? Let's think for a moment. The moment you think of a financial institution, what is the picture that comes in your mind? That it is a large organization, it is run by professional people. Not only professional people, they are highly qualified people, they are highly paid people. Yeah. So also the kind of funds that they have at their disposal are very huge. And if they have huge funds at their disposal, which means that their outlook for their investments is also long term. They can wait for their investments to fructify over 3 years, 5 years, 10 years. Some investments they might even hold for 25 years. And LIC is one such uh, institution that has been holding a sizable number of stock in sizable percentage of a lot of companies for decades together. Then you have the mutual funds. Now, mutual fund could invest for the short term or long term. Most of the other characteristics resemble that of a financial institution. Large in size, run by professionals, having qualified people, having access to all tools of trade, having lot more information about markets by their very nature of working. And but sometimes mutual funds, one thing is slightly different is that they depend on the end investor for what to do, to show them the direction of what to do. And I will give you an example of this in the next 30 seconds. Let's say markets are doing well and more people are putting money in, let's say, UTI mutual fund. So what UTI mutual fund will do is it will keep collecting that money and keep issuing you units of that fund. But when that fund reaches the fund manager, he has to deploy the same fund in the market. So if he has to deploy the same fund in the market, he will have to obviously buy shares. He might wait today, he might wait tomorrow, he might wait till next week, but he can't wait forever. He or she will have to deploy that fund at the earliest. Otherwise, a mutual fund manager's performance is calibrated vis-a-vis the movement of the Sensex. If the Sensex has moved 100 points, and if my NAV has not moved up proportionately, my year-end bonus at the end of the year will come in problem, or my performance vis-a-vis other funds will be questionable. So a mutual fund cannot sit on funds indefinitely. They have, if they have got the money, they have to deploy it. Similarly, let us look at the reverse situation. A mutual fund investor starts withdrawing his money. So there is obviously some cash reserve that the fund keeps. So first it will pay the unit holders from that reserve. But what if those reserves fall short? Naturally, they don't have a choice but to sell shares in the market to repay the investors. Now, why am I telling you all this? The reason why I'm telling you all this is because of these objectives. The moment you begin to appreciate that different kind of people in the market have different objectives, their behavior will suddenly start making sense. Now, when you say foreign institutional investors are buying, every evening there is a figure that is published by both the exchanges that today FII buying was this much, local institutions were buying this much. So that gives you an idea as to how the qualified money is thinking in the market. Let's say if you read in the paper, mutual fund has been selling. So it could either mean that mutual fund is booking profits in the market, or it could also mean a lot of investors are withdrawing money from the market. So that might give you some kind of hint. Corporates. What do corporates have to do with the market? Well, corporates are the raison d'etre for which the markets exist. It is these corporates who first offer their share into the market for getting capital. Once they get their capital, let's say a promoter holds typically 51%. One believes that if a promoter is holding 51%, nobody can snatch the company away from that promoter. So there are very many cases wherein promoter stakes are very low, 26%, 28%, 29%, and the rest of the shares are floating in the market. So almost 70, 72% shares are there in the market. So let's say there's a foreign investor who likes that business and it is available cheap. He or she might just buy 51% shares from the market, and the erstwhile promoter will suddenly realize that my company has gone away from my hands. Of course, Indian institutions have, this kind of an activity that I just described is also known as a hostile takeover, wherein someone with lots of money comes and raids the market, accumulates a lot of stock of the target company, and tries to snatch away the company from the promoter's hands. We've not had too many instances, luckily, in India, but in foreign markets, you hear of this and you see this very often. Traders, we discussed. For traders, it is a business activity. They constantly keep looking at the screen, do their buy sells trades, and try to make that money at the end of the day as much as they can. For investors, their objective is only savings. Where to channelize their savings? What are the other options for an investor to save? You can put your money in bank fixed deposit. You can put it in public provident fund. You can put it in post office. You can have private company fixed deposits. Maybe you can go and buy gold, silver, bullion, maybe make jewelry out of it. Why I don't consider jewelry to be an asset is simply because, whenever you're buying raw gold, the mixing of alloys therein is minimal when you buy a gold or silver ingot. But the moment you convert it to jewelry, it is not the same asset, because to shape the jewelry, they have to mix certain alloys, and that reduces your percentage of gold therein. Also, there are making charges in jewelry, which kind of reduce your quantity of gold and increase your expense. So jewelry, I don't consider to be as a most optimum investment. Real estate can be a very good investment, but the problem about real estate, or the challenge therein, is that today, if you have 500 rupees, can you think of investing in real estate? Obviously not. Real estate, the ticket size is very big. Although now there are certain instruments that are coming known as REITs, Real Estate Investment Trusts, REITs, Real Estate Investment Trusts. So what they do is, there's a trust that is created where a lot of money is collected. That trust will acquire a real estate property, and we can buy units of that trust. So which means, if the trust has 100,000 square feet, I could perhaps be owner of 1 square feet in that 100,000 square feet, and whatever rent earned out of that becomes my return. So there are very many instruments coming, but why stock market scores over all the other instruments of avenues of investment that we have discussed, is simply because ease of entry and exit. Today, you walk into a broker's office, you don't even have to walk into a broker's office. You fire up your mobile phone, you can open a account with an online broker in a matter of minutes at minimal cost. Plus, the entire life cycle of a trade and the execution of the trade is, everything is online. So, which is why you see the cult of Robinhood investors doing very well during lockdown. In fact, so much so that, now in the world of investing parlance, Robinhood investor has become a formidable class of investors. The closest example to Robinhood in our country is investors who are trading with one of these online platforms like Zerodha or Grow or Upstock. These are, discount brokerage houses where the brokerage rates are extremely low. Their entire offering is online. You can open your account in less than 5 minutes and get online. So coming back to the advantages of stock trading, the biggest advantage is your ease of entry and exit. The charges that you pay are very minuscule. The return that you get is quite high. But that also, the flip side is the amount of money you could make also could be money that you lose. So either make or lose. But if we say risk is there everywhere. Even when you're walking on the streets, there is risk. Tomorrow some car may come and knock you off the road. Yeah, so what is the risk management you do? You stop walking on the road, you walk on the footpath. So it's not to say that if you're walking on the footpath, the risk is not there. There also there is risk. There could be a risk of tree falling down, but hopefully that risk is lower. Or there could be a risk of some car coming on the pavement and hitting you, but that risk is that much lower. So as long as you can manage a risk, you can say it is risk free, because at least you've learned how to manage the risk. So the idea of investments is to first knowing what the risks could be. And second important point is, having known what those risks are, we have to learn to manage them. And the moment we learn to manage the risks, we are more or less comfortable, and we say that it is a relatively risk-free place, which is why for people like us, we've been in the market for over now 25, 30 years. We are generally aware of the risks. So we believe that we know what the risks are. We've learned how to manage them. We teach our clients how to manage them. So we find this to be a risk-free place. Jobbers, arbitrageurs, and operators. Jobbers, by their very nature, like I said, they are buying huge quantities of share and dealing only in 5-10 paise difference. They help create narrow spreads. They create a market. So what are spreads? Spreads are nothing but the difference between buy and sell. So if you ask your broker, if you call him up and say, what is the price of Reliance? He'll probably say 2201 and 2202. Now this difference between 2201 and 2202 is what the spread is all about. So if you are going to buy a share of Reliance, you are going to have to pay 2202. If you're going to sell the share of Reliance, you're going to get 2201 as the money that you will get. And this difference is made by the jobber or scalper. But of course, this was more prevalent in the days when there was open outcry system, when all trading was physical. People used to congregate in a trading ring and do buy, sell with all that noise at Dalal Street. Now, of course, it's all, the action has shifted on to the cyber world. It's all automated. It is virtual. So these spreads, because now this opportunity is offered to all the people uniformly. Earlier, only those people who could access the trading ring had an opportunity to become a jobber or a scalper. But tomorrow, if you decide, you can also become a jobber or a scalper. Go to the Reliance counter, fire it up on your phone, and you see if the difference is 2201, 2202, you can put 2201.05, and for selling, you could, put an order at 2201.95 instead of 2202. So it's become a democratized system. It offers equal opportunity to all, and you can now participate in that activity right from your mobile phone. Same thing about arbitrages. So if you open any sophisticated app, you will see it will give you prices on both the exchanges, and it will also tell you the difference between the two. So if you're quick enough, maybe you can buy in one exchange and sell in the other. Of course, these differences are more in theory than in practical now, because computers have started trying to identify these differences and make good of them. So there are very powerful computers sitting in server rooms that keep looking at these differences. So for human beings to make good of this is now getting more and more difficult. Uh, with this, we have covered the objectives, who the players are, what are the objectives, and with this you will get an idea when you want to enter the markets as to how you want to go about it. So I will pause now and open the floor for question and answers, if any. So if there are any questions, I'll be happy to take them.
Sir, I had a question.
Yes, please.
How reliable are these discount brokers?
Uh,
How
oh,
reliable are these discount brokers?
yeah. Uh, the simple answer to that is, see, we have a market regulator by the name of Securities and Exchange Board of India, namely SEBI. Now, SEBI has laid down certain rules for who can be a broker, what broker can do what amount of business, how much maximum brokerage they can charge, what happens in case of a broker default, what are your remedies against a broker. All this was not there 20 years back. 25 years back. SEBI has been around for 25 years or a little more than that. Before that, it used to be a black box. You could walk into any broker's office, open an account. There was no paperwork done. Whether the broker himself was solvent or insolvent, nobody knew. But now all these things are, monitored very carefully. So my simple answer is they are all safe. You check the level of service who is giving. You check what is the best fit for you, and you can absolutely without any problem deal with them. There is no problem. In case of any problem, you can be sure that there are enough mechanisms within the system to redress your problems.
Thank you, sir. Thank you.
Yeah.
Students, do you have any questions? Students? I doubt, sir.
Okay. So no problem. With this, I enjoyed taking the last two sessions immensely. I hope the students and the faculty have also enjoyed it, and I hope they've gained something out of it. And hope to see y'all or hear from you in the near future.
Sir,
Thank you very much.
there's just a question. Sorry, sir, when you were just thanking,
Yeah,
there is a question.
yeah.
Just typed it in the chat box.
Yeah, please.
Ask, is it better to invest in Upstox, sir?
There's no problem. Upstock is also like Zerodha. It is a brokerage house. It's a discount brokerage house. So there are so many. There is Grow, there's Upstock, there's Angel, there's Falana, Dimka. There are lots of those. But yeah, there is no problem going through Upstock also. If you're comfortable, why not?
Any other questions? Any other questions? Thank you very much, sir. Thank you very much.
Okay, ma'am. Thank you for having me over. Yeah, since I have another engagement, I sort of cut it a little short because I have to be somewhere. Yeah, thank you so much. I'll exit the meeting now.
Thank you, sir. See, tomorrow morning again we have a session at 10:45. We are all joining. I want all of you all to join. Shubham, please tell your classmates also, you are all third year students. If you can't cooperate this bit, because it is all arranged for you. Not the question of cooperating, it is like taking benefit when we do something for you. Okay? Thank you very much. I'm ending the meeting here. Anything else? I'll end it